Welcome back to Where Money Meets Love, a short video series that focuses on the connection between love and money management. I am your host, Janelle. Joining me today is Mrs. Melissa Richards, Business Development Officer at the JDF Cooperative Credit Union. And today we'll focus on Don't Let Debt Break Your Heart. Melissa, welcome.
Thank you for having me, Janelle.
Let's jump right into it. Why do people tend to borrow impulsively even though they know it may not be wise?
Janelle, it boils down to three things. One, the instant gratification of getting that money. Two, their emotions. And three, the access to the credit. What they don't realize is that borrowing this money right now without having a specific purpose is going to affect them in the long run. So let's look at it this way. You borrow some money now for something that you really never need to borrow for. Let's say a party you keep and you want some clothes, yeah? But what you're not realizing is a year or two down the road, you will need to find the first deposit for your first move. What you will find that most people do at that point is seeking to borrow again, not realizing that it's going to affect their debt service ratio, because those are things that we take into consideration when somebody comes to borrow. So if your debt service ratio is above a certain limit, we're not going to lend you money. Let's look at it this way. Debt service ratio is calculated on the dollar. So let's say you're earning $10 and we say that let's say your debt service ratio is 60% on the dollar. We're saying that you must not spend more than 60 cents of that dollar. So when people borrow consistently without specific purpose, it is going to affect them in the long run. When it is that you really need to get a loan for something that is important, you may not be able to get it because you borrow all these loans all over the place, and then now you need to find the first deposit. You can't get the funds because your debt service ratio is out of.
In simple terms, how does interest affect the true cost of a loan?
Interest rates and terms tend to affect your loans that you borrow. So depending on how long you take to pay the loan and the interest rate, that's what determine how much you pay at the end. So those two factors is what affect the cost of.
How can someone recover if they realize they've borrowed more than they can actually manage?
Borrowing more than you can manage is a bad thing, right? Because it's going to affect everything about your finance. So let's look at a scenario here. Let's say your income is 300,000, but because of your loans, which in some cases is not at one entity or it's not just one loan. If you have one loan, then your payment tend to contract. If you have a lot of loans, then your payment is going to expand. In other words, be more. So in calculating your debt service ratio, as I mentioned before, it is going to impact you negatively. So it's always important to borrow only what you need, not what's available.
How can members ensure debt supports their goals rather than delay them?
Debt can support your goals. It just means you have to prioritize. So your debt can be beneficial because debt is not always a negative. So depending on what you're using the money for, the purpose is what determines if you're benefiting from the loan that you borrow. So let's take it a little further. Everybody needs to have a home. And you purchase the home today, in a couple of years, that house will appreciate. So even though you're paying a mortgage consistently, it is not a negative, because if you should sell that house in another 10 years, you're going to benefit from the fact that the home would have gained some value. While if it is that you, let's say, just borrow some money to purchase some food, Once you purchase the food and you would have eaten, then you don't even remember about what you purchased. But of course, the loan will still be there. So um, it all boils down to the purpose of the loan.
So we have good debt and we have bad debt.
Oh, yes, we have good debts. Good debt, in my view, as I said just now, a mortgage,
Hmm.
education, maybe a motor car. Bad debt, in my view, is to borrow
Gift
to buy
loans. A
clothes or to
little.
buy the little things
Yeah.
that we can do without.
Are loans a bad thing?
No, it's not. Responsible borrowing is important because as long as you're borrowing to meet specific needs, then it's not a bad thing.
Melissa, those were some very good insights you shared with us today. I want to encourage our viewers who are possibly having challenges managing their debt to put these tips to the test and watch their money work for them. Join us next week where we turn the spotlight on making your money love you back. I am your host, Janelle. Bye for now.